Today, we're going to talk about why markets continue to struggle in the face of a very aggressive Federal Reserve. By the end of this podcast, you're going to have a good idea on what they're doing, why they're doing it, and if these actions could turn into a policy mistake or something worse. Welcome to The Money Runner. I'm David Nelson. Investors understand markets are a discounting mechanism. We look to perceive future cash flows to price an asset today. Doesn't matter what the asset is, stocks, bonds, real estate, even art. All are subject to the financial laws of nature. Art doesn't generate income, at least not until sold for a profit, but that in itself is another form of cash flow. Assets compete for your dollars just like everything else. And the rallying cry for the last 12 years, at least when it came to stocks, was that there was no alternative. Well, that's no longer true. Today, there is. Right now, a risk-free asset, a US T-bill, can pay you over 4% on your money for just 1 year. For a lot of investors, that's an attractive rate of return and one where they can sleep at night. Especially institutional investors like insurance companies who were dragged into this stock market kicking and screaming because bonds didn't yield anything. Now, of course, they can return to their roots. The above begs the question, what do investors need to see for stocks to start working again? We know it won't be when the economy begins to regain traction. If history's any guide, the launch will be well in advance of the economic bottom. Investing is a combination of science and art. The science part, that's easy. Most valuation models start with the risk-free rate, and as we're learning this year, each stair-step higher in the terminal rate has meant a stair-step lower in valuations and stock prices. Digesting an endless stream of data, portfolio managers like myself, we look at the breaking news, we layer in our subjective thesis to come to an informed investment decision. You know, sometimes I wish I was a football coach. The game of football seems a lot easier to understand. The players and coaches have an exact idea of how far they have to move the ball to score a touchdown. The end zone, it doesn't move. Stock investors, we don't have it that easy. For most of the year, the Fed has moved the goalposts, pushing them further and further away. At the start of the year, we thought the terminal rate, or the peak of the hiking cycle, would be about 3%, and we wouldn't get there until sometime in 2024. Today, those goalposts are a lot further away. Fed fund futures point to a 4.7% terminal rate, way higher than we thought in January. Fed has been raising rates all year. In fact, last week, they hiked another 75 basis points for the third time in a row. Since the start of the year, the dot plots, which track where Fed officials believe they're taking rates, that's continued to move higher. The good news is that we've been here before, and today that implied peak rate for next year is very close to what we thought it would be back in June. The bad news is that the risk-free rate is only half the battle. We're still a few weeks away from next earnings season, and already the bad news is starting to come in. A couple of weeks ago, FedEx guided lower, and just last week, Ford offered a grim picture of the current earnings backdrop. Ford cut its EBIT, or earnings before interest and taxes, by 34%, in part because they couldn't get parts needed to finish the cars. I don't think the reasons why really matter. If you can't finish cars, and in turn you can't deliver them, you don't need as many employees. How long will it be before Ford announces another round of layoffs? In the last few weeks, Peloton, Snapchat, Alphabet, Meta, Wayfair, Microsoft. When was the last time Microsoft cut employees? Bed Bath & Beyond cut 20% of its workforce. I could go on for another 5 minutes. I'll repeat what I said in my post last week. Managing monetary policy is like steering a battleship. You have to make the turn well in advance of the pivot point. I'm not the only one who feels this way. Professor Jeremy Siegel, professor at the Wharton School of Business in Pennsylvania, professor went on a rampage on Friday, seemingly incensed with the press conference that followed the Fed's decision last week. Calling it poor monetary policy is an understatement, he said in a conversation with CNBC anchor Scott Wapner. Professor Siegel believes the Fed is embarking on another policy mistake, the first in keeping rates near zero in the face of obvious inflation last year, and the second today, oversteering monetary policy. He points out a year ago, commodity prices were screaming higher, and they continue to keep rates near zero. He goes on to say, today, we have the opposite. Commodity prices are falling, mortgage rates have doubled, and are now over 6%. All of these are leading indicators. The professor got some support from none other than Tesla and SpaceX CEO Elon Musk. Over the weekend, Fortune magazine ran a story with a comment from Mr. Musk saying Siegel's comments were obviously correct. Look, I'm in the same camp as Elon and the professor on this one. The Fed will likely go too far and not only wipe out inflation, but the economy along with it. We're going to need some kind of balance in Fed thinking. Sure, you want to cure the cancer, but you don't want to kill the patient in the process. If you like today's podcast and want to keep up to date on what we're posting, hit the subscribe button and feel free to post comments, good or bad. By the way, don't forget the Market Minute podcast every morning. It gives you what you need to know in front of the trading day. Thanks so much for joining. I'm David Nelson.